Hello guys, forexbrokers.net here, and this video deals with how to trade a hammer pattern and how to make the most of it. It's not only a pattern that appears on the currency market. It can be used on any type of market as long as you have Japanese candlesticks, because this is a Japanese candlesticks pattern. It is a Japanese candlesticks reversal pattern in the sense that it forms at the end of bearish trend. So pay attention to have a bearish trend before you trade a hammer. And like all Japanese reversal patterns, and actually like all the classic technical analysis patterns, it has a brother, if you want, or the opposite pattern, the shooting star that forms at the end of bullish trends. This is a very important pattern because it is formed out only one candlestick. This is how a candlestick looks like. This is the euro, US dollar, and the hourly chart. This is how a candlestick looks like. And on a candlestick you have what? You have the real body, which represents the difference between the opening prices. Imagine this candlestick here, for instance. This is the opening price, this is the closing price. So this is the real body. The real body can be green in the case that the candlestick is bullish, or red in the case that the candlestick is bearish. It has an upper and a lower shadow. And these are all the elements of a candlestick, in the sense that when you interpret one candlestick, you look at the real body, the lower shadow, and the upper shadow, and that's it. And based on what you see, or based on the size of the real body, the presence of the upper shadow and the lower shadow, you will determine the type of the candlestick, if it is a hammer or what kind of a candlestick it is. In a hammer, this is a one candlestick pattern, and it looks like this. In a bearish trend, or during a bearish trend, the market falls, and at one moment in time it puts, not this one, let me take this one. At one moment of time it puts a new low, and that low, or the price action during that low, looks like this. Imagine that this is the real body of a candlestick, and this is the shadow, the upper shadow and the lower shadow, and this would look like a hammer. For a candlestick to be a hammer, there is one condition to consider: the real body, or this real body. Imagine that this candlestick here, this is the real body, so this real body should fit at least or minimum 2 times into the lower shadow. So this would be, in this case, 1 time and then 2 times. The more the real body fits into the lower shadow, the more powerful the hammer pattern is. The opposite of a hammer pattern, obviously, is the shooting star, and the only difference between the two is the fact that the real body forms at the lower part of, this is a shooting star, for instance, but for a shooting star you need to have a bullish trend, then the market here forms a shooting star, and then the decline starts. That's the only difference between the two. So if you know how to trade a hammer, then obviously you should know how to trade a shooting star. Before going to examples, imagine that on a hammer the real body's nature or color doesn't really matter, in the sense that you may have that the real body has a bullish color, in the sense that this is the opening price and this is the closing price, so it would be green in this case, but you can use whatever the color you want. Or it could be a bearish one, in the sense that this is the opening price and this is the closing price, in the case of the hammer. Now, for a hammer, this is very important. We must have, or the market must form, a bearish trend before the hammer's formation. If we do not have a bearish trend, you should simply ignore that candlestick, even if the candlestick forms, but you need a bearish trend. For instance, this candlestick here, this one here, It looks like a hammer. It has small real body, a small upper shadow, and a very long lower shadow. And if you try to, or if we try to fit the real body into the shadow here, we have what? We have 1, 2, 3 times. So it fits the rules, but there is no bearish trend. Hence, we cannot trade this hammer pattern. You need a bearish trend. A bearish trend, for instance, might be such one, from here to here. This is a daily chart, and you see the price action here covering probably 2 weeks. With, if we include this one, so for 2 weeks the market moved to the downside. It forms this hammer, this candlestick here, and then we have what? A very small real body. Remember, the more the real body fits into the lower shadow, this time fits something like this one, fits something like 4 or 5 times, maybe even more, into the lower shadow, the more powerful the pattern is. So how to trade the hammer pattern? The thing to consider is, or to keep in mind, is that the hammer shows a conflict of interest between bulls and bears. Bears dominate here, also here. Bulls try to take over bears, failed. And the hammer pattern, the reversal pattern, shows this battle between bulls and bears. In other words, trade a hammer on a pullback. Never trade a hammer from the moment that the candlestick ends. So the thing to do is to measure the size of the candlestick or the size of the hammer. Use 2 horizontal lines, and this is the size of the hammer. And from its absolute high to its absolute lows, then find out 38.2, 50%, maybe even 61.8 for more conservative trader, but more aggressive traders should use the Fibonacci ratio and to go long on 38.2 retracement, 50% retracement, something like this. So this is the place to go long. Not necessarily on a specific level, but on an area. Place a stop loss. Always have a stop loss at the bottom or at the lowest point in the hammer. This is where you should place your stop loss. And as a crucial money management rule, you should go for minimum 1 to 2 or 1 to 3 risk-reward ratio. What does it mean? It means that if this is our risk, let's assume that we go on the long side on 50% retracement. So we have a pending order. This being a daily chart, it is best to use pending orders because you don't know when the market pulls back. And in this case, it took, this is the Sunday candlestick, this is a Friday, so Sunday candlestick. On a Monday, on the opening, after the opening, it went like this and went and filled the pending order. So a pending order placed on Friday or early Monday opening, at Monday's opening. And then the market filled the order. This would be the risk. And then if we project the risk 3 times or 2 times to the upside, this would be 1 time. So risk reward 1-1, risk reward ratio 1-2, risk reward ratio 1-3. This would be the exit level for the hammer trade. And namely, in the same candlestick, you will have 1 to 3 risk reward ratio. Always have a stop loss at the lows, because this being, again, as I mentioned, the conflict of interest between bulls and bears, bears will try to go for the lows. They often will, and they often succeed. For instance, this one could be a hammer as well. You have a bearish market. This could be a hammer. You have a pending order, 50%, market comes and takes your stop. No problem, you are stopped here. But this is the reason why we use risk reward ratio 1 to 3 risk reward ratio or even more, so that if you fail on one trade and succeed on the next one, then using a risk reward ratio of 1 to 3 gives you more chances for the account to grow. For instance, you have one losing trade, or for each winning trade you have 3 possibilities to avoid falling below break even if you lose 3 consecutive times, which rarely happens. So this would be the hammer, but this would be also the opposite of a hammer, the shooting star. As explained earlier, it forms at the end of bullish trends. We will move on with a different concept, still on Japanese candlesticks patterns, and you will see that somehow they relate with the hammer pattern. Bye bye.